Joining us now, Mr. V Vaidyanathan, Managing Director and CEO of IDFC First Bank. Mr. Vaidyanathan, good morning and thank you very much for joining us. As always, congratulations for an excellent show in terms of growth of deposits and advances. Let me start with the deposits part itself. We saw the announcement of you dropping your savings deposit rate. What has that done to your cost of deposits? How much has it fallen? What is it quarter on quarter?
Basically, our deposits are coming very strong, as could see, like 39% year-on-year growth. And we don't need that much deposits anymore because now we're largely paid off all the past borrowings, the legacy borrowings, IDC Limited. So that outstanding legacy, borrowings have come down. So now we need lesser deposits. So we brought down rates of interest. And in any case, we found that interest rates are not that sensitive in the early buckets. So we dropped it. We are very, very happy brought it down to 3% just now. Yeah,
but for below 5 lakh, it is 3%. But if you can, I mean, I don't know if you have it right away, but your cost of deposits will be very helpful if you can, if you have it readily.
Yeah. I can tell you cost of funds, if that's a good proxy. Our cost of funds right now is running 6.4%. And 6.45%, and for the residual 10,000 crores which yet to pay back, if you pay them off, it will come to 6.36, which frankly is the lowest among the let me say mid-tier banks peer group. We're very happy that we're also raising 39%, also lowest in that mid-tier peer group.
Okay, now the Reserve Bank's new liquidity ratio is on the anvil. How much might that push up your cost of deposits?
About 2 to 3 basis points.
That's it. Because some people are calculating 10 bips, etc. For you, it would be that small, is it?
That's all it is. And I'll tell you the numbers so that people can reconcile the numbers. We think that at the new norms, we'll need about 10,000 crores of more deposits or more funding to keep the LCR around, say, let me say 115%, because at that level of conservative, hopefully that's a good number. And if you take a negative 70-80 basis points on 10,000 crores, our impact is 70-80 crores. For a large bank, 70-80 crores is not that material. It'll just go through.
Okay. And what will that do anything to your margins? Can you give some guidance on margins?
I told you, 2-3 basis points. That's not materially moving the number.
No, not at all material, if it is only 2-3 basis points. You know, I wanted to check this, and if you remember, we had the discussion last time as well. You know, your NIMs even otherwise are fairly high. It's at 6.2 or something, your NIMs? Yeah, On top of that, you have a cost of deposits of 6.4, you said, or cost of funds. So what is the average lending? It would be north of 13%, your average return on loans?
Well, Lata, this is your favorite question, by the way. So
yes.
I must answer
because there are slippages, people worry, and that's why I have to ask.
But I want to correct you on that first opening sentence you made. I need to correct you when you said slippage.
Sure.
You know, seven quarter high or whatever. That's not correct, by the way. Please check your research. But the numbers are to just share with you that our credit cost, because end of the day it's credit cost, end of the day it's provisions. How much are you having to provide? Now, our number we have guided is 1.65%. And because of the joint liability group issue, which we'll come to if you're interested, but that is giving us 20 basis points because of Chennai floods. So 1.85% is in best in class in this league of other institutions who are in the same space as ours, best in class. So I just want to share that with you, that even at a NIM of 6.3%, and we have fees of about 2%, let's call it 6.3 plus 2, that's maybe 8.3. And then we have credit cost of only 1.85. It's a very good bank coming up.
Okay. No, at the moment, your slippages, I think, rose by about 23%. Do you think this is a one-off? It will be more controlled in coming quarters?
I told you, because we haven't yet come to the discussion, but basically there were floods in Chennai, Tamil Nadu, and there was some impact. But fundamentally, I told you other numbers. Gross NPA is 1.9, net NPA is 0.5 or 0.6. Credit cost is guided, the numbers I told you. So they're all good.
Okay. So this 1.65 is the credit cost for the current quarter, or for the quarter gone by. What is the guidance?
Guidance is, 1.9 is the number for the quarter that gone by. We are expecting elevated credit cost in Q1 and Q2 because of the floods which I talked about. Q1 and Q2. In the upcoming quarter, we're expecting elevated credit cost. So let everybody know so that everybody can expect it from us properly. But Q3, we expect to slow down. And Q4, we won't expect to have even lesser provisions. So this is how the play out because of the event of things.
Fine, got that. Now, let me come to your ROA. You have targeted higher ROAs, but this quarter, obviously, it's slipped below 1. What is your guidance on ROA?
Our ROA right now is like stable at 1%, marginally above 1%, on a stable state basis. We think that in the next 2 years, by 2027, we should touch about 1.4%. That's the way we have done the modeling in the bank.
Okay. You have provided a very interesting and new welcome disclosure in terms of vintage loan performance analysis. Can you take us through that? The net takeaway for me was that now the quality of loans is even better than pre-COVID times. But can you explain?
Yes, actually, the background is that many analysts sometimes used to tell us that, look, your credit cost is looking so low. Ever since COVID, our credit cost the lowest, in that peer group of similar lines of businesses, or quite low. So people tell us, we don't know what 27 is going to look like. We don't know. I mean, how do we know what to look like? So we drew up a vintage chart. In the vintage analysis, just for benefit, what we do is that we evaluate a particular portfolio we booked, say, pre-COVID, and then we vintage curve the delinquency of customers booked post-COVID, and then we check for like-to-like delinquency of 6 months on books. If that is X, what is it now? We are finding at every data point, 6 months on books, 9 months on books, 12 months on books, 15 months on books, every vintage curve, the bookings since post-COVID have materially lower than the past. So I believe Indian credit system has also maybe gotten that much more maybe conscious of credit. Yeah. I don't know, but our numbers are looking good, excluding the microfinance business.
No, that is an observation. If you remember, the CEA in the economic survey also said the twin balance sheets, which were an issue. Now, both corporates and banks have far cleaner balance sheets. Cost to income ratio, is there any guidance you can give on that? I mean, you have elevated levels, obviously, for legacy reasons, but they have been coming down. You can guide on that?
Yes, it's a very important question you asked, so I must explain. In the initial stage of the bank, we had close to about 78,000 crores of legacy bonds to pay and certificate of deposits. That's a very big number. So we had to raise deposits to pay that. And for that, we put up close to about 750 new branches, 1,100 new ATMs. Yes. It was expensive to do all that work. So all that cost to income ratio has now come down to 72%. It was 95%. Next 3 years, we think it will be 65%. And in this disclosure this time, Lata, we have given segment-wise 3-year picture of what the cost-income ratio will be and how they will add up. For example, just to take one data point for you in that, interest of time, on credit cards business, we were 240% 3 years ago. Then we touched 160%. Last year, 116%. This year, we expect to go inflection point. We want to go below 100%. And by FY27, it will be 75%. So by scale, it is coming down. And so people should expect from us cost-income ratio every year from now on, including this year, should come down in 25, 26, 27. You should expect it from us and we will deliver.
Okay. No, there's no taking away from the credit that you and your bank deserve in terms of the number of branches you'll have increased. I think from 2018 to now, 3-fold or 4-fold increase in branches. That's no mean achievement.
Five-fold.
Okay.
Five-fold and booked all the expenses and still brought down cost-income ratio.
That's very creditable. Let me, one more guidance. Apparently, I have time. What's the expectation in terms of credit growth? Which verticals are going to fire for you?
Regulator has constantly been signaling growing the secured book because, want to go there. For us, frankly, both are behaving well, but we want to heed the regulator. Okay. And we also think it's a good in the longer run for our bank. So we are building a gold loan business in a material way. 2 years ago, a year ago, it was 250 crores. Now it's just 1,000 crores. End of this year, we want to be 3,000 crores. So gold loan is a big one. We are growing our tractor financing for PSL purposes. We are growing the commercial vehicle business for PSL purposes. We are building Kisan credit card. So these are the 4 or 5 new businesses we launched. Okay. And we want to do all of them.
Yeah, so you don't have to depend on our IDF. Very quickly, half a second. Any chance that you will tap the market? The market is in a giving mode now.
No. Our capital adequacy is 17% plus now. If you factor the
So
latest
no
money,
need.
so not at this point of time.
Well, there are
But,
lots of people who are tapping because it is giving and not because they need. But I take your point. You're comfortable on capital. Thank you very much.